independent financial advisor, for example, but this video and webinar is for educational purposes only. Okay, so thank you for your attention on that. So as I said, today's event is sponsored by Admiral Markets, and there's some cool stuff you definitely want to take a look at. For example, buying and selling directly from the MT4 platform. So make sure that after this webinar you take a look at these cool stuff, these cool features, and try a demo or a real account sometime soon. Okay? Alrighty, so today's goal, we're going to take a look at all the ins and outs on money management. And we'll be taking a look at R2R ratios, for example, risk management, as well as stop losses, and some added weight and fib money management. All right, so some questions maybe before we start, just quickly. Do you risk a fixed amount of money or a percentage of your account? What do you think R2R ratio is, for example? And do you know why we need to place a stop loss? Why is that so important? I know that not everyone has time to write an answer, but pick your question and we'll share the feedback with the group if you have time. Okay, so that'll be cool. So, the tripod of successful trading.
Well, guys, yeah, this is most important to begin with. The tripod of successful trading, you need to know basically three simple things. First thing is you need to know your profitable trading strategy. And I don't necessarily mean on the system. It's your trading, it's your way of trading, be it a system or naked trading. So first of all, you need to get well known to your trading strategy. And you need to know a good and systematic approach based on technical and fundamental analysis. You need to know when news will be scheduled. You need to know technical analysis for that day. If you're an intraday trader, you need to get accustomed to trading. And before all that, you need to practice on demo account, and you need to have a good screening time. For example, if you went with there are a lot of courses over internet for Forex trading. But most important thing, when you finish your course, you need to practice it. You need to do a demo trading. Don't invest your money unless you're willing to lose it in a couple of months. That's most important, screening time. And the next step, when you get enough of screening time, it's your risk management. Over time, you will learn how to control your risk. Money management, for me, is the most important part of trading. Even with bad risk-to-reward ratio, you can still have good profits. And I will show you that on later examples, how you can be profitable even if your risk-to-reward or your system is only 30 or 40% accurate. You will see there is a strategy for that. You will see how you can do that. Also, you need to be a strong and well-developed character, because trading psychology is your inner self. Strong and decisive mind can work wonders in this market. And I'm not taking Forex as a game, because maybe you've read a lot of times that people refer to Forex as a game. They say you need to be successful in this game. Forex is not a game. Maybe it's a game for gamblers. But in next couple of hours or in next hour, you will see what differs Forex from gambling. You will see a strict and a big difference between Forex and gambling. So this business is not for scared people, not for scary traders. And this tripod is very, very important, because if one leg of this tripod falls, all will fall. So it's most important to be concentrated on those three things. Do you agree with me, Chris?
Absolutely. It's I
have learned it over time.
Triple of risk. Yeah, yeah. It's the psychology, the risk management, and the trading risk and money management, and the trading strategy. It's the fundamental of a house, basically, right? You have the base of the house, the walls, and the roof, or the tripod, whatever comparison you want to make.
Yeah, if the foundation of the house falls apart, the whole house will fall apart. That is the problem. Yeah.
Yeah, absolutely. This PowerPoint is doing funny. It's changing the colors. Okay, it doesn't matter.
Yeah, now we are getting to another thing. You know, you also need to know about principles of work organization in a proprietary trading firm. There are three things and three important, how can I say, people who are working for a trading firm. Because I also worked for a trading firm. I was a head trader of Platinum Investment a couple of years ago, and for this year I did some honorary job. And it's the organization is the same in almost every good trading firm. We have analysts. Analyst business is to search for trading ideas, do market research, and make trade analysis. And what he does basically is he presents his work to a trader. Then trader makes his decisions about entry size, stop, profits, etc. Analyst also check the pairs, give suggestions to a trader, and trader carries on with the job. And that is the most important part of this organization. Analysts and risk managers are some sort of strategists, and the trader is a soldier. And the trader is he's the one who pulls the trigger. It's like in the military, you know, strategists make good plan, and soldiers carry on with the plan. And we also have a risk manager. And risk manager has a really hard job because he controls the risk. At the start of each trading day, he analyzes the potential risk, and if a company profits, for example, from markup and commissions, he needs to calculate needed lot size, and he presents that to a trader. So trader will make an ultimate decision to open a trade and to control a trade based on informations which are given by analyst and risk manager. And that is really very important to have an organizations in organization to have things going like this, because trader is very hard for him to make his own decisions if he doesn't know what the risk is and what technical analysis gives him. So in a good big firm, trader needs to be aware of those things, and he needs to communicate with analyst and risk manager. Yeah. And well, you know, everything we do, we need a plan. And this is very important. Trading without a plan is the same as going into the desert without a map. What will happen? You all know what will happen. You will all be lost. And if you don't have a plan, if you don't have your strict plan where to enter, where to take profits, where to put your stops, what is the daily average profit you might have, you will go, you know, ad hoc from case to case. That is not okay. You need to have a plan. And a good trading plan includes a trading plan for a session and a trading plan for a quarter. Trading plan for a session is maybe more important because it's almost an everyday trading. We have news, we have pre-market analysis, we need to know about analysis of good and bad trades we made in previous period, and what are our expectations for the day. And trading plan for a quarter includes a whole lot of sessions because it's a long-term target. We need to have defined a long-term target. For example, 3-month or 6-month target, or our yearly target profits. For me, I have my weekly target. And I'm not concerned if I lose. I know that by applying a strict money management rules, I will preserve my account. And that is the most important thing I have learned over time. It's not that I earn always high profits. The first and primary task and the rule of thumb for me is not to lose a capital and stay on the flow for many years. Why? Because if I lose my money, I don't have more money to trade with. You know, I have a strict amount of money and I need to protect that. how can I protect that if the only thing for me is to make profits? Because not every day we will be in profit. Sometimes not even a month, but it will, if we get an average of 2 or 3 months that we are in profit, it's excellent, because after a year we will be making profits. But it's not our primary goal. Our primary goal is to protect the capital so we can have money to work with. And then we gradually multiply our equity figures. We add profit to a profit, then we withdraw it. And by doing that, we earn high profits. And the main problem with many people is because they set the third task for the first place. They switch those rules. Their problem is, and the main thing is to earn high profits, not thinking that they can lose the capital. And believe me, success comes down to proper risk management. We need to know those risks. And when I show you how I trade based on maybe every 5 or 10K, maybe you will be, how can I say, astounded, but I guarantee you, I promise you, this is a way to success. Because you will be making money every week, and then maybe you will be making money every month if you know how to do it. It won't be huge. It won't be huge. But it will be maybe between 2.5 and 10% per month. And it's okay to have an average of 5% per month. Believe me, if you have between 5 and 10%, now I'm telling you, you are excellent. There are people and traders who maybe make, I don't know, 200% per year. But believe me, if you make between 5% and 10%, by applying this money management we will show you, I guarantee you will be successful enough. And the most important thing, you will preserve your capital. Yeah, and that's it, Chris, yeah.
Okay. I was clicking because last time we got all kind of red colors. No, we got red colors last time, so I thought probably we'll have the same now, but this time not. So yeah, we can see how, vital risk management, money management, trading strategies, being confident with your trading strategies, trading psychology is, and we of course discussed trading psychology in 2 separate webinars the last 2 months. That was great stuff. I hope you enjoyed that, and we're definitely going to look at more trading psychologies and strategies as well. But today, vital part as well, the money management. So money management, how do we deal with it? Where do we put the risk in a risky situation? How much do we risk? Where do we target? All these kind of questions, right? And it's really key. It sounds, of course, very easy to maximize every win and minimize every loss. It isn't, unfortunately. I wish it was. But once we master this, then we can really make sure that, first of all, as Nenad said, we don't lose our capital, because very true is that once we lose it, we don't have the capital to trade. So that's the #1 rule. So here are some things that I think are important to share with you regarding money management, because this is my personal feeling regarding the goals that we should focus on, because I think some goals are maybe misleading or, in my opinion, not optimal. So I noticed that a lot of people focus on pips, for example. Well, I'm not saying that in a forum you don't necessarily have to write how much you earned. Sharing pips is fine, but if you really want to talk about it more seriously, I think that focusing on a percentage or how much you earned is a better measurement, basically. It's our goal is to make money and not pips, basically, right? So also it makes us more consciously aware that the money is at risk. Trading it boils down to is we have to treat it as a business. It is a business. We have to plan it as if it's our business, right? So as Nenad said, it's not a game, and I think that some traders might go into that sphere. Well, if you have your own business, for example, a retail store, you're looking at cash earned and cash spent, and not some fake numbers or something like that. I mean, not that pips are not fake numbers, but you know what I mean. So Also, another thing I want to take a look at is that basically, in theory, it doesn't really matter if you risk, say, 1% on a trade. It really doesn't matter how big that stop loss is per se. It's not like if you're risking 20 pips instead of 30 pips instead of 20 that you're necessarily risking more of your capital, right? Just to make that clear, because you can adjust your size to what you're risking. So if you're risking 1%, it always is 1%, even if you have a 30 pip stop or a 20 pip stop, right? So then two things I've noticed when talking to traders, that some like to risk a percentage and others like to risk a dollar figure. And I personally, in my style, I use a percentage, but I wanted to show the advantages of both sides, kind of. So the disadvantage maybe of using a risk percentage is that even if you would immediately adjust your percentage to the new, you have a capital. Let's say you have 10,000. You lose $100, so you have 9,900. You lose again $100, you have 9,800. So you're adjusting. If you take again 1%, you're actually risking $98. So you're automatically adjusting your position size, which is the advantage, but also the disadvantage for some, because they say my strategy always has a win percentage of 60%, and if I start adjusting, the dollar size basically from 100 to 98, because the risk, my trading capital is going lower, and if I use the same risk, I'm actually risking a lower dollar amount, but I have a 60% chance of winning, right? So why should I decrease that? I want to have the same dollar figure because I know that if I have two losing trades in a row, I want the next one could be the winner, and I want to risk the same, basically, in dollar terms. All right, so that's their thinking. Also, some say that for smaller accounts, it takes maybe too long to build an account, for example. That's they think is a risk because it could lead to overtrading. If you take small percentages, you might think, oh, it's only 0.5%, so you might think, oh, why not? I'm only risking 0.2%. I might as well take it. So some think that that's a drawback with that kind of reasoning. All right, and yeah. So the advantage, though, of course, there's definitely advantages of risk percentages. I use it myself. Is it allows a trading capital, to grow fast. You can reinvest those percentages, but most of all, it protects your account. If you do use a fixed figure, depending the relationship, that could go pretty fast down, and if you don't have the experience, you could lose that trading capital before you know it. And as we said, the #1 goal is to avoid losing our trading capital. So that's the biggest advantage.
And we also need to know about a plan for trading. We need to know when to open a position, when to close a position, how much of capital we are willing to risk, and what ratio of risk to reward we should apply. And we all do that by having the plan. And if you are intraday traders, you need to have this plan and to apply this plan each day. You need to be patient, because patience will eventually pay off. You don't enter blindly in trades, and you don't close your trades blindly. You need to know when to close a position based on your technical analysis, or maybe on technical analysis of an expert who you believe in. And you need to know how much of capital you're willing to risk, how much that trade will earn a profit, and what are potential disadvantages, how much are you willing to lose. So this comes to very, very important things of psychology. Chris, do we have a psychology slide now, or maybe we will see later?
Yeah, I think we have it now. Yeah, we do.
Yeah, because that's it, guys. This is very, very important. This is a psychology curve, And this is, I can say, this is an emotional curve. And just take a look at this picture. And the emotional curve behind the trading is very steep. If you see that, it starts with optimism and then gets down. Yeah, you can, and then it gets down to euphoria. And I will explain all of these points one by one. In that point, there is a maximum financial risk. And then, when traders start to lose, the curve gets in downward spiral. And the biggest problem you can encounter is that you can get trapped in that emotional spiral. And of course, optimism normally characterizes the start of the cycle as you buy your, I don't know, your pair or you sell your pair, and naturally you have a positive outlook for the future and anticipation of potential gains. And then we go to excitement, and it's a quick to follow after some initial success as we begin looking for new ways to accomplish more based on what we already achieved. We want to accomplish more. And then when we accomplish more, we get thrilled. And thrill comes after yet more success as you begin to delight in your wins and congratulate yourselves for your smart decisions. You know, I think that we all experience those kind of stuff. We are all getting very thrilled. We are, you know, we feel like we are gods. And then we get to euphoria. It's the peak of our emotional curve. And that is very dangerous. That is when we are most vulnerable. How paradoxical may it sound, it's really the truth. Because euphoria sets in as wins come quick and fast, and bringing in a stream of easy profits and pushing our sentiments to dizzy heights. And that is really a big problem, because the market can turn down. Now we are most vulnerable. We think we can do everything. We think that we can earn profits, that we will be millionaires in a couple of days. We will be, I don't know, we will be the richest guys in the world. But then, as always, market turns in a contrary direction, and it comes to anxiety, and it inevitably interrupts the climb, and the market surprises us by moving, for example, downwards. We have buy position, and market starts to move downwards, and we are faced with our first potential loss. Maybe we reassure ourselves that our calculated strategy will deliver in the long term, but of course we are losing, and it comes to denial, and denial takes this to the next level, and markets still show no sign of a rebound. In this stage, we begin to deny that we maybe made a poor choice, clinging on to believe that things are going to improve. We are in denial phase. We pray to gods, you know, to whoever it may be. It doesn't matter with religion. We are praying that the price may turn up in our direction, and eventually, at least, we will make it to break even. But what happens next? You know, we all experience that. Price starts to get in a consolidation phase, and there is nothing more than a slight up, and then it starts to go down again. And we start to feel fear. And it finally takes hold when the market realities set in. We know what reality is now. We are aware of our surroundings. And amidst of the confusion of getting things wrong, it's easy for our sentiment to drop drastically, and for doubt to set in, and fears, because the fears that the market will never move in our favor escalate. The fears escalate, and we fear that we won't have the opportunity even to break even. And then it comes down to desperation. And desperation sees a frantic attempt to salvage the situation with any idea that might have a chance of helping us to break even. We are desperate. We are trying to cover our positions. Then we are going to multiply our position. We are going to add to add a big percentage of our account to a losing position. And it's not like adding to retracement. I will explain that. When desperation sets in, we are not trading anymore. We are losing. That's not trading. And then what happens is panic. We are very, very afraid, and all options are exhausted, and the road downhill is imminent. It will end with capitulation. Eventually, we will close all of our profits. The first position we will get out, then the cover up position, which we use to cover up for the losing trade. It's double loser, and it's called capitulation. We will close all our positions because we are afraid to lose, to be margin called. And capitulations really torments us, and we need to admit defeat and give up hope of things turning around. And now we are shifting our focus from recovery to damage control, and we need to exit the order to avoid being margin called or making farther losses. And then maybe when things are settled down, we come to the point of maximum financial opportunity. We come to despondency. It's a sort of calmishness, and that is the lowest point of the emotional roller coaster. We cash out whatever we might have, having given up hope of the markets ever recovering. With the wounds still raw, we vow never to enter a position mindlessly, and we begin to reason ourselves, and we begin to feel a signs of a slight relief, and it comes to depression. Yeah, we are depressed, but we are being reasonable. That is the most important thing, because when we were in euphoria stage, we weren't being reasonable, and now when we have received a slap over our cheeks, now we are reasonable, and then we, the fallen traders, we ruminate on our failures and regrettable decisions that contributed to our losses. And then hopes return slowly after we notice that markets are picking up, and we realize that markets are a cyclical thing. Whatever comes down, it needs to get back up. And now we again cautiously begin to look out for our next opportunity. And that is the point of maximum financial opportunity. Only then we can make sure, and we need to avoid this downward spiral. We need always to stay in this, I cannot say despondency or depression, but we need to learn ourselves to be always in the point of maximum financial opportunity. It's not necessarily this downward spiral. It's the mindset of the successful trader. It all comes to this, the mindset of successful trader. Because when we learn to cut off this downward spiral, we will develop a successful mindset. And we can do it harder way or easier way. And that is what I, of course, during my trading career, I have experienced all of this. But now, when I'm talking to you, I have cut off this downward spiral, and I'm always calm. I'm always cool when I trade, even when I lose, because my money management will not allow me to lose my capital. Okay. And now, when we are talking about stop loss, this is very important. In order to protect your profits, you need to know what stop loss order is, be it a mental stop loss or even better, a fixed stop loss. What is
or both loss? Actually?
I agree, Chris.
Yeah.
And it's if you want to say something, it's okay, because I wanted to say how important stop loss is, and I will be short with this. A stop loss order is designed to limit a trader's loss on a trading positions. It's important to know that stop loss is stopping further losses, and it is for novices, for newbie traders. It's a psychological load. Why? Because novice traders don't know where to put the stops. The worst case scenarios are stop loss of maybe 200 pips with profit of only 20 pips. And some expert advisors work that way. The thing is we need to preserve the account, then be profitable. And this is what Alexander Elder, the creator of Force Index, said. People are choosing a short-term gain in spite of long-term prosperity. And it's a mistake. We need to choose a long-term prosperity. And methodology of stop loss is, for my style of trading, set stop loss before or after local lows or highs, and or use statistics. It's a floating loss, for example, on profitable trades, trailing stop or something. But we need to set our stops. And my methodology is to set stop loss before or after local lows or highs. Do you agree with me, Chris, with this sort of information?
Yeah, definitely. I like to, put stop losses also at a good place where the market structure tells me that the likelihood of it being hit, it's protected in some way or another, either be it a fib or a zone of price action, or maybe a big reversal candle. It depends too, or indeed a swing high, swing low, for example. So it depends from point to point. But I think those stop losses are safer in a way, and yeah, it's makes more sense to me than using a random number of pips like some might do. So that's what I always look for. I look at the market structure indeed, and then try to decide what place will the stop loss be, that if the market would go and take my stop loss, then I actually want to be out of the trade, because my trading idea or strategy, my plan, is invalidated. So that's of course the best spot to have it, basically. And yeah, it is a tough thing. It's a psychological load, definitely. I mean, it's the moment we accept a loss. So that's not the easiest, and we don't want to postpone that moment, but it is tempting. But we have to avoid it, because otherwise we can keep moving it, and that's not good, because we have to realize the stop loss is there to protect our capital, not to trade, basically. Because choosing a price, if you change it one-to-one, is good. It doesn't matter really what prices you get, because it's your own money. So, but if you use leverage, then the stop loss is to protect our capital, and not necessarily the trade idea. So, yeah. Oh, it's making red
of course.
lines here.
The most important thing for this is to traders needs to know where they should put their stop losses. And stop loss, as this picture says, it won't save a trader from a bad system play, but it will slow down the ruining time while giving him a chance to think and learn. So what I'm saying is, if you don't know how to do that, okay, I'm telling you, try to practice it on demo account. Here on your USD example on 1 hour time frame, we can see that these kind of trades are very easy to achieve, because those are trend trades. And for example, if our stops have been placed below these swing lows, it would never been hit. And you can see that you can apply, if you're a trend trader, it's always good to apply these kind of stops. Placing it, for example, if we are in a buying mode, we should place our stops below swing low. And on this particular example, swing lows are marked by these red crosses. So you can see every time, and every time in this good trend, the stop loss has never been hit. So you need to know, if you're trading even on 5 minutes time frame, switch to 1 hour time frame, and then you enter, for example, on 5 minutes, but you put your stop loss on 1 hour time frame. It's most important thing. Or if you're trading 4 hour time frame, enter on 50-minute time frame and put the stop loss on last swing high or low, above or below swing high or low on 4 hour time frame. And believe me, guys, this will prolong your days, your trading days. This will prolong your trading career. I can say that.
Now, I think that if there's any advice that's the most valuable, I would say it's this, indeed. I totally agree.
I always trade with stop losses, always.
No, not only having stop loss. I meant like using a like the swing high of a one high.
Yeah, swing high and low. Yeah, that's it. That's it.
Oh, Lazar is asking if we can repeat that. No, I basically it's just the fact that if you use a time frame, whatever it might be, let's say 15 minutes, that you take a look at the 1 hour and look at where is, for example, the red check that we have here on the time frame, right? On this, sorry, on the screenshot, excuse me, you know, and use that as your stop loss. That's the most safest, basically, right? So that will give you some more protection.
Yeah, if you trade on lower time frames, use higher time frames to determine your stop loss. That's it.
Yeah. Absolutely.
That is how we do always.
And that ties in nicely with this part, because if you're wondering, well, that makes my stop loss a bit looser, you know, it's important actually, first of all, not to lose a trade. So, okay, you could have a bit looser stop loss, but if the odds of your success increase, all right, then it's well worth it, right? So, and also don't realize that a wider or looser stop loss, they don't have any impact on what you actually spend or risk, all right? It's all up to you. It's always your choice what you risk. Is it 1%, 0.5%, 2%, hopefully not more than 2 to 3, because then you're over-risking probably, but you get the point. It's your choice. Now, this is called basically position sizing, so that you're ensuring that you have the equal risk on your trade. And that basically means that you look for the most desirable stop loss. So first you say, okay, I'm going to take 1% risk on this trade. Then you say, okay, where's my logical stop loss? Choose a stop loss that is safe and protective, and you have good reasons that, you know, that's a high probability that the market will not go there. All right, so choose the most logical. Now, you don't want to go all the way down to 1,000 pips from here, because then, of course, you don't have any reward to risk, right? Then you're over-risking in pip size. You want to still keep it logical in that sense. So not too tight, not too wide as well, but a logical stop placement. And then you can do the following. Say that your stop loss is 40 pips, whatever, in this case, and you're risking 1% of your account is $100. Then you can calculate that you're going to take 2.5 minis, all right, roughly speaking, all right? So that would be your lot size. And then it has here an example that we can use.
Yeah, this is the example. For example, what should be the size of the opening positions? For example, for a beginner, stop loss should never exceed 1% from the client, from equity, basically. That's from equity. Be it if he trades on his own account, on others' account, it should not exceed 1% from equity. And we have example here. For example, if deposit is 500 euros, our risk is 1%, and it's okay. It's 5 euros. And for example, we are trading on Euro USD currency pair, and we have determined the stop loss of 30 pips. For example, our last swing high or low is 26 pips. We make our stop loss 4 pips above is 30 pips, and the risk is $300 on a standard lot basis. What does it mean? Standard lot applies, for example, for $10. 30 pips is equal to $300. And how now we determine not to risk more than 1%? By applying a basic formula, risk divided by stop loss. Risk is 5 divided by 300, it's 0.016 lots. So you need to trade with mini lots. And if you're willing to risk only 1% of the account, you can apply this formula. Risk divided by stop loss. Risk is a risk percentage, and stop loss is always calculated on a standard lot basis. So it's really easy to apply.
I think it's a micro even, isn't it?
Yeah, there is a macro,
right?
Yeah.
Exactly.
They can make it in Excel. It's really not hard. It's very easy to make it.
Yeah.
And
actually,
basically
I've heard
now,
we have micro lots, but I even heard about brokers offering a tenth of a micro lot nowadays. I don't know how they call it, I forgot, but it's getting smaller and smaller.
Now, guys, if you want to learn it easier way, then if you are novice traders, I'm talking about novice traders, I can make myself, okay, I'm a full-time trader, I can risk some more, but never more than 3 or 4%. But basically, if you're new to trading a job, you need to know the risk, and never more than 1%. Because if you learn how to deal with 1%, you will learn eventually how to deal with a little bit more. So try to protect your profits and try to apply this formula. It doesn't sound much, but it's okay. 0.016 lots on this particular account, it's really enough, not more than that.
One of the reasons why the stop loss size is important is not because you're going to lose more money. As we know, we've established that you're the one who chooses the risk, right? But it is important in another way, though, because if you have a certain stop loss size, it's going to have an influence on either your reward to risk or maybe your strategy percentage win success rate. All right. Now let me explain that. So, for example, if your stop loss is 30 pips and your target is 90 pips away from here, that ratio is 3-to-1, and that's a good ratio because you're basically trying to gain 3 times the amount what you're risking, right? Simply put. Now, another way of doing that is that if you take a smaller stop loss and you use the same target, for example, if you were to manage to get a 20 pip stop loss or even a 15 pip stop loss, but you keep the same target, then of course you manage to make that ratio 6-to-1, for example, with the 15 pip. Now, 6-to-1, of course, is even better. That's a super great reward to risk ratio, and if you take a 1% risk and you manage to reach the target successfully, you just made a 6% trade. So you can open the champagne bottle, do a bit of celebration dance with that. That's great stuff, of course. So if you manage to make a smaller stop loss, you're going to have a better R2R ratio if you keep the same target. If you decide to lower the target, for example, to 60 pips, you still have a 4-to-1 reward to ratio, right? But maybe the odds of your trade becoming successful increase. So that's also beneficial. So there are advantages of keeping the stop loss not too wide, but we don't want to crowd it as well, as we mentioned earlier in stop loss section. Now, can a trader, I should formulate it differently, be profitable with 30% win percentage? Is it possible? Yes or no? Do we see any Y's, any no's? Any answers?
Any answers? What do you think? Can you be a profitable trader with 30% win?
Oh, we got a smart. Yeah, it's an easy one. Oh, we got a smart class here, isn't it?
What do they say, Chris?
All of them, yes. So we should pick harder questions.
I would like to know how.
Yeah. Oh, one says depends on the expectancy of the system. Yeah, of course, that's the answer. One maybe. Okay. In today's conditions, it's harder.
Of course, a lot harder. Yeah.
If the RR ratio is 4-to-1, use RR accordingly. Alrighty. Good job. Yes, by achieving a 3-to-1 reward to risk, for example, you are actually getting 3 units of profit 30% of the time. So if I did my math correct, then you should be profitable, indeed, because of that R2R ratio. So yes, with a sufficient R2R ratio, you are a profitable trader. So, for example, this might seem a lot of text for the moment, but I'll walk you through it, okay? So, for example, here, this was the beginning of the euro down move on the 1-hour chart when we made this down move, right? We went down, and now we're moving up. But this was the very start of it, okay, just in case you're wondering. So for example, this was moved down, and because of your analysis, you anticipate a continuation. This is a 50 fib, for example. Entry, 50 fib, stop loss here, for example. Take profit at this target. You know, the specifics, let's forget about the specifics, but let's say that's the trade. And in that case, you have this risk for 125, reward 190 pips, and your R2R is 1.52. All right? Now, let's say that you didn't take that trade, but you see that the currency goes down and makes a hook back. And not only that, but you see many wicks here, 4 hours of sideways move, some bearish candles in the meantime, and you decide to give it a chance when it starts to move down a bit. Here at 35, you put your stop loss here. It's a 35 pip risk. And the reward, if you would go for the same target, right, it would be 175. And all of a sudden, you change that 1.52 to a 5-to-1. And of course, that's almost more than 3 times a better reward to risk. So instead of 1.52, you get 5% reward on that 1% risk. All right. Now, the difference, of course, is that in theory, this stop loss here is the ultimate safe garden or safest place, because if you put it there and the market would still correct higher to this fib, for example, it still could go down. Your trade idea could be right, but you're taking out with this stop loss. And ultimately, the trade is wrong, of course, only when the market would go beyond this place. So this is safer, but if you have sufficient reasons maybe to tighten it to here, as you can see in this example, you would be able to get that advantage and higher R2R. And you know, in that case, even if you're wrong, you only need 1 out of 4, right, to make profit, and 1 out of 5 even to be break even. So that's definitely in your advantage.
And now we come down to leverage, guys. And now I will explain. This is maybe the most important thing for me, how I do it and how I suggest you should do it. Listen to this carefully now. We should never go with more than 5-to-1 leverage. For example, if the account balance is $5,000 US, we should not trade with more than 2,500 per position. It's, if you're using MetaTrader 4 standard, it's 0.25 MetaTrader 4 lot size. It's 0.25 because mini lot is $10,000. And you will, this way, if you trade, you should keep your profits and you should keep your balance intact. You will, maybe you will lose some, but you will earn, you will preserve your capital. If you're trading with $10,000, I recommend 0.5 lots overall. For example, you're having 5 positions. Each position should be maximum 0.1 lot. So it comes down to 0.5 maximum. So for every 10,000 account, you add 0.5. On 20,000 account, you trade with 1 standard lot. Well, maybe it sounds like it's not much, but this way you will earn profits, and you will, if you lose, you won't lose much. If you're trading with $30,000, then you will use half of it, 1.5 lot size. And you never risk more than 2 or 3% per trade. If you know how to trade, you are not a novice trader anymore. You know with trading basis, you know how you should trade. You have your plan. And for example, if the stop is 30 pips, we use the following formula. Stop loss times the leverage divided by 100. In this case, it's 30 times 5 divided by 100, and it's only 1.5% of a risk. So basically, if you do this as I suggest you, it's 1.5% per risk. And if you want to risk a bit more than 2 or 3%, you can use double the size. But that is only if you're willing to risk more than 2 or 3% per trade, if you know how to do it. And now that is all comes to this. If you're trading with $10,000, for each $10,000 trade with 0.5 maximum. The maximum of maximum is 1 standard lot, never above it. And try to trade with at least 1 to 2 R2R. In these market conditions, it's very unstable and volatile. It's okay if we trade with 1 for 1, but we need to make sure to have at least 60 to 40 win to loss ratio if we want to be successful with 1 to 1. We need to know that is what I told you on the start of this webinar. You need to know your system. You need to know your way of trading. And if you're sure that you have 60 to 40 or 70 to 30 win to loss, you can go with 1 to 1 risk to reward. But the basic thing is, don't over leverage. Don't go with more than this is the most important part. For each 10,000, go with 0.5, maximum with 1. If you're very, very, very sure of your trades, never beyond that. You will preserve your capital and you will keep your profits. If you're having, for example, $5,000 in your account, go with 0.25, maximum 0.5. But that is in, if you're scalping or if your stops are really tight, then you should go with that. But anyway, between 0.1 to 0.25. The same applies for $10,000 accounts. 0.2 to 0.5 lots for each maximum. I'm talking about maximum position size. It should never exceed 0.5. This way you will, I'm telling you, and believe me, this way you will preserve your capitals. Your earnings won't be maybe as big as, I don't know, 20% per month, but you will earn money on constant basis. You will earn money on constant basis, and that is what counts. You need to be profitable over a longer term period, not just 1 or 2 or 3 months. Maybe if you want to take this job seriously, you want to be profitable on yearly basis. So this is how I do it. This is my example. Okay. So Chris, you can proceed with this risk of ruin table.
Yes, indeed. So, just to give you an idea what kind of win percentage approximately you would need to be profitable with a 1-to-1, while in theory, 51% would do, but I don't think anyone would be that excited with such a small edge. Probably also if you look at the transaction cost, it wouldn't be enough. So let's put it on 55. Probably 60, as Nenad said, is more desirable. But in any case, you get the picture. And of course, the higher that percentage is, the better with the 1-to-1. So if you manage to get 65, you'll be doing a lot better. That holds true for everything here. So if we look at 2-to-1 and you have a 40, you are of course making a nice consistent edge on the market. And if you manage to get of course 21-to-1 is a bit exaggerated, but just to give you the idea of the win percentage that you need regarding break-even point. So for example, 20-to-1, of course, with 5%, you would be roughly break-even. So if you get 10% wins, you would be doing pretty well. Now, of course, something like that is difficult to implement because if you have 9 losses in a row, I don't think that would help the trading psychology all too much. So there is some connection as well with that. So you want to find a balance with that. But I see I made a small mistake here. Apologize for that. I think it should be the other way around. But in any case, with a 4-to-1, this is probably 30, and this is the 36. Okay. So just to give you an idea what kind of win percentage you would like to get with this R2R. That's good to know when you're trading.
Okay, yeah, and these are stop loss limits, and it's easy to follow. For a beginner, stop loss should never exceed 1% from clients from equity. Daily loss limit should be 2 or 3 stop losses maximum. Because of that psychology, I'm telling you, you need to cut that downward spiral we were talking about. Also, it applies to weekly loss limit. It should never get more than 5 to 6 stop losses in a row. because it will have an effect on your psychology. And to be a profitable trader, you need to be a strong-minded and decisive, and you should not be feared of trading. And believe me, the less trades you make, the better is the result. And on the first stage, it's best to limit the maximum amount of orders placed per day. For example, in these conditions, I rarely do than 4 or 5 trades per day. For example, there were many weeks, a lot of times I went with only 1 or 2 trades per day, because I'm not sure what the market will do. There are a lot of consolidation period, a lot of news affecting the price, and I wait. I'm patient and I wait, and I never overtrade, because I have burned all for example, in the last 2 years I have encountered some problems because I worked in a group, and when you work in a team, there are many people who can influence your trading, and they can say, okay, go with this pair, try to enter positions. Even I'm a trader, and even if it's contrary to my you know, for my mindset, I need, maybe sometimes I listen to them and then I lose. Then I always lose when I listen to other. And then I decided it's always good to work by myself. I don't read others' analysis. I have my own thread. I have my own way of trading, and I'm happy with it. Because it happened to me 2 or 3 months ago that I listened to my friend who is a really good trader, and together we were trading, and we both lost. But it was his trading decision, not my trading decision. With my trading decision, I'm calm. But when I listen to other trading decision, even if it be a, I don't know, well-known trader, you know, I always believe in yourself. Believe me, guys, always believe in yourself. If you want to follow the analysis, it's okay, because you can have a bias or something like that. For example, when I do my daily analysis, I always say those are supports, those are resistance. I cannot give you signals because it's not my job to give you signals. Sometimes I can say, okay, it's okay to enter here on that. I do that occasionally from time to time. But in order to learn from me, you need to know why I do that. And if you agree with that, even better, then you make your own trading decision. But you never let others influence your trading. You should never let others tell you, okay, enter now, enter with 5 lots, for example, on 10K account. Why? Because if you lose that, it will take time to recover. It's only one trading opportunity, and if you don't make a good trade, it will really take you time to recover. And the secret of success is, it all comes to this: losing trades should be closed fast, profits should flow. Cut the losers short and let the winners flow. And that is always like that. And I think that you all agree with me, because I know that many of you experience all these things from time to time. Right, Chris?
Yep, absolutely. Yeah. Oh,
so always, yeah, and you always need to know what you need to know yourself, your inner self, because if it comes to your ego, if you want to do revenge trades, you will lose, and I promise you will lose.
That's for sure, indeed. Yeah. That's especially if you see. I think revenge. There's so many things that can cause this. You know, that you saw a trade but you hesitated, as you said in the psychology lesson, right? And then you see that it went your way, and then you revenge trade, you take it, but then you take it at the wrong point. You know, you actually try to take the same setup, but later on, actually, when the market is doing something else. So that's the worst thing that can happen, indeed. Absolutely.
Of course, and traders need to know about trading hours. For example, I don't trade every hour. For example, the most successful trading session is for me is London. First 3 hours of London and first 3 hours of New York session. That is how I work, because we can exploit some breakouts, we can have fake moves, we can do trend trades, and that is, for me, it's excellent way of trading. First 3 hours of London and first 3 hours of New York session. And this is the difference if you risk 2% and 10%. Now, just if you paid attention carefully to what Chris and me were talking about, this is the summary of it. If you're risking only 2% of total account per trade, you see, the picture speaks for itself. After 10 losing trades, just imagine 10 losing trades. It's really a huge loss, you would think. But if you risked only 2%, you would have made only 17% of the count loss. That is negligible, really. That is, you can recover that in a couple of weeks or maybe in a couple of months. But it is you protected your account.
Yep.
But if you risked 10%, you would have lost 60% of the account after 10 losing trades.
Yep.
And now this is what we were talking about.
Absolutely. This is
never ever over leverage your positions, no matter how big your account is. If you go with 0.25 on 5K, 0.5 on 10K, you would be okay. But if
this is vital.
Yeah, this is vital. But if you go with 3 lots or 2 lots or I don't know 5 lots on 10K account, hey, it's only 20 pips, and you will lose. You would have lost maybe 10%.
Yeah, yeah, absolutely. And that's why risk management is so important indeed.
And Chris, you know why I have never had any big success on this? I don't know, Forex Ball Championships. It's excellent. Because in a Forex Ball, guys, I encourage you all, go in a Forex Ball Championship, apply to that, because you can practice your trading strategies. You can practice, go with high lots, doesn't matter, just practice.
Yeah.
And this, when you go live, then you should apply a good money management. And this is why I have never had any success on this. I don't know how to, I just don't know how to trade with a big risk, really. And that is, you know, and that is the biggest thing of my mindset. I risk always small. Maybe I don't make that much. I'm happy with 5 to 10% per month. But it's okay if I make less. But my losses are really cut off.
I got once a recommendation though of someone to watch a webinar. I haven't done it yet, of a person who said, like, you know, if you have a small account and you're willing to take the risk of losing it, that you can try to build your account to get to better higher levels. I've never watched the webinar. It's risky though. You really need a strong psychology for that.
Yeah, and
you're really taking a risk for losing that capital indeed. Yeah.
I can add, if you're willing to lose the money, go for it. It's okay. Yeah. Maybe you would have some luck. Maybe you would
but it's
make
a risky
that.
business.
Yeah. It's very risky business, guys. Serious trading. You cannot be serious with even, how can I say, $1,000. Really, it's too little for serious trading. You can practice with 100, 500, but it's 1 in a million that can make from, I don't know, 100 to $20,000. It's really hard. Don't expect most of us. I cannot do that, because you know what my trading style is. I have built my position. I have built my account over time. You know, slowly. I go slowly. I'm very patient.
Yep.
I don't know how to make very fast profits. I have burned many times. I'm just not sure that I can do it. And that is because I'm willing to make between 5 and 10% per month, and I'm okay, really. I try to do that on constant basis, and I'm happy with it, you know.
Yep. Now that just to give you an idea, we still have we're about 2/3 of the slides, so we'll have to move a bit faster maybe. For those of you who still have time, that'll be cool, because we still have some cool slides left, so hope you stay along.
Yep. Okay, yeah, and this is what we are going to do now. Just a slight talk about risk management. We have positive and negative mathematical expectancy. That is basically a coin flip. It's a random game, and that is told by Ralph Wins. And this next example should explain you a bit. Correct and rational control over capital provides positive mathematical expectancy. You see, for example, if our target price take profit is 55 points and stop loss is 20 points, what would have made if we only had 30% of success? This is what Chris explained to you. 30% times 55 points minus 70% times 20 points gives us positive long-term win. So basically, if we have a system or training style which gives us 30% of win, we are still going to be positive if we use a good risk to reward ratio. Yeah, that's it.
Cool.
This is the formula for this, and you can see that.
Yes, exactly. Nice formula.
Yeah, nice formula, and that is what you also explained.
Yeah.
10 minutes
so,
ago. Okay.
Just a quick note on maybe how you want to like define your current trading capital. You can choose basically to keep the same amount, right? Time in over and over. Although then you don't have the flexibility of adjusting your account to losses or profit. So that could be risky, and you could be risking more and more of your capital, right? Now, if you use a flexible, that means a constant update of the current account. So if you lose 100, right away your new trading capital is 9,900, right? So you're always using the new balance, and it has the advantage that you can keep growing the account capital. So it's eventually 12,000. So you're actually 1% is worth more, right? If you use a fixed amount, then it's always going to be $100, and your trading capital is not growing in that amount. Or you could use something hybrid, for example, in between, where just to give you the options here, so that, for example, if you have reached 10% profit, you use the same capital, and when you reach 10%, you increase your trading capital by, for example, 5%. All right, this is your choice which numbers you use. You could choose 20 and 8. Whatever, just to give you an idea that you can use the same trading capital till you reach a certain level and then increase the trading capital. Maybe even the same for the downside if you want to make it easier calculations. Say, for example, I accept a 3% drawdown, I use the same trading capital, and once I reach that, you adjust the trading capital, for example, if you want to make it more easier for yourself. This is an example of if you do use it to reinvest, and you use the same percentage, right? It's a compounding an example. You can see that then that 1% quickly turns into 128 pounds. Well, if you started, you had 100 pounds. It's still 1%, but the figure is a lot more, right? So that can quickly compound into more.
And basically, we will say now what that strategy is. It's called compounding. You don't withdraw money with compounding strategy, because what means compounding? What does it mean? The ability of an asset to generate profits, which are reinvested into other profits to generate their own profits, it's called compounding. In other words, maybe it's easier to say it's generating profits from previous profits. And it's not you don't use the compounding strategy for paying off the bills. You don't use it for living. You are using it for your savings. It's some sort of investment strategy. And 20 pips per day is enough. And there is no withdrawal of money, and the basic thing is adding profits to profits. You use profits to generate profits. And you saw the last slide, which Chris shown to you, you can make a lot of money just by using compounding. But you should always know how to do that. And 20 pips per day is really enough if you use our money management rules. That is what I...
sorry.
Yeah, no problems. You can keep on going, Chris.
Okay.
It's not easy. You can do that on Excel. It's just...
Yeah.
You need to have a good amount of money to start with. Yeah.
Yeah. So basically we have, I just wanted to quickly give you an idea, if you use Fibonacci, if you are a Fib trader and you like to use that method, what you could do, for example, is maybe money management technique to try to, instead of taking one entry, to split that into the most logical Fib levels that you think have validity. Now, it does depend on factors, for example, which time frame, current market structures, that you'll have to determine yourself which Fib levels you like. But you could split, for example, instead of taking the entire risk on the 50, is you could think about splitting that risk on 2 Fibs. So what you could do is, for example, determine the fact that you take, first of all, 1% risk, and then you split that 1% risk, say, among 2 or 3 Fib levels. So you say 50, 618, and 786. So you're saying, okay, I have 1% risk, but I put 0.33, 0.33, 0.33 among those Fibs. All right, so that you, in total, in that regard, get a better average, entry average, than if you would put everything on the 50 Fib. Now, I've read a percentage regarding the Fibs that would make a Fib trader want to do this, because I have read the statistic that 74% of the time the 50 Fib gets hit, so 26% of the time it's actually a lower Fib, 236 or 382, 62% 618, and 52% 786. So there is a positive expectation in that regard, if you use these statistics, of using lower Fib. So in the division, what you could use is, for example, 25% risk on 50, 35% on a 618, and a 40% risk on a 786, for example. It's just an example. It would depend on case to case, in my opinion, but if you want, you could even use it as a fixed rule. But that's something that could be used to get an optimal or better, entry average. And the entry average, of course, will determine the stop loss size. So by doing this, you basically get a better stop loss size, which will positively affect, of course, that reward to risk ratio. So that's why this is important for our money management. And you could do the same with the targets, basically. You could take two or three targets, various Fib targets. So, for example, if you get a 786 bounce, you could decide to take part of your trade, a third as well, for example, at the minus 272 target. At the 618, you could decide to take part at the minus 618 target. And maybe with a lower Fib, higher Fib, 50 Fib or 382, you can go for a higher target. The reasoning is because if you get a deeper retracement, you want to maybe block in some profit, while of course with the higher Fib, 50, you want to go for a higher target because of the R2R ratio, basically. A 786 is a small risk compared to the stop loss, but a big target compared to the minus 272. So you're already locking in a very big R2R there. But if you use a 50 Fib, the minus 272 target is already quite close, so that R2R is not, it's not as good as 786. So that's why you want to go preferably for a higher reward there. Now, of course, if you're really going into these kind of levels of targets, you don't want to be foolish, and you don't want to give back all that profit to the market. So you do want to think about trading stops, even taking profit right at the 1618, for example, and stuff like that, because you don't want to give up that much profit. So, that's how you can use Fibonacci entries and targets to optimize the reward to risk ratios that we've been talking about if you are a Fib trader. If you are an Elliott wave trader, you could think about the following. This is actually a plan that's from Bill Williams' book. What's his name of the book? Trading with Confidence? No, I forgot. You have to forgive me. Anyhow, Bill Williams, he had this trading plan regarding Elliott wave, and basically he says that he's looking to put more risk on depending on where the currency is at what structure. So if you're in a wave 2 and you just had an impulse, good wave 1, you want to be risking something like the 60% of what you're normally risking. If you already have the wave 1 of 3 going on and you're in the wave 2 of 3, you want to do more risk because you've just actually confirmed what you were thinking. Your analysis is confirmed, so you can add a bit of risk, and probably the wave 2 is already out of risk. All right, so you're adding only a new part, so you can be a bit more confident. Then the full risk you want to put on the wave 3 of 3, which is the most impulsive and the most highest of power. So that's where you want to put the most risk. And then just a tad of risk on that wave 4 for the wave 5, because that's when the market is more iffy, the retracement is shallow, won't go that deep, so it's difficult to determine the ending point. And the wave 5 is more or less shorter, so you don't want to put too much risk on that. The wave 4 also is normally very long and lengthy and a lot of consolidation, and so you want to be more careful with that. Also, it influences not only the risk percentage, but it also influences the entry fib of your choice. For example, if you're on a wave 2, they're normally deeper, so you could maybe be a bit patient and wait for the 618 or the 786. While a wave 4, if you're counting on the 786, then it's probably not going to happen. You probably have to look for some price action signals at the 382, for example. So, the wave count will also have an influence on which fib is realistic in that regard. Same for the targets as well. If you're in a wave 1, you could go for a higher fib target for wave 3. But if you are in a wave 4 and you're expecting a wave 5, then you might want to aim a bit closer with your targets, because the market could turn faster and you might not even reach your target. So you want to be more conservative then if you expect a wave 5 with aiming for targets. All right? So that's how you could use the Elliott wave and Fibonacci elements. And here's just a quick practical example of that, how you can use it. For example, this is the Eurodollar 4-hour chart, and you can see the market made a nice 5 wave for a bigger wave 1, and it makes it a deep and complex wave 2 with some moves up and down, but eventually it hit the 618. It was shy of the 786, unfortunately, but we would have gotten this this entry in this example, right? Because we expect a deeper wave 2. So you can put 60% on that wave 2, and you can see that you get an impulse for the wave 1. All right, now Elliott wave, I'm not saying this is a different topic again. We already talked about Elliott waves in a previous webinar. But just to show you what kind of range of possibilities you have to your disposal, wave 2 of the wave 3, right? Because this is the purple wave 3, and this is the purple wave 1, right? So we're talking about internal waves. So once you have 60% going on the bigger wave 2, right, then you can add another 80%, for example, on the internal wave 2. Let me use a different color. Internal wave 2, 1 second. Oh, internal wave 2 of the wave 3. You can add this 80%, for example. And then you get a smaller 5 wave for wave 3. And then the shallow of wave 4, as you can see, it doesn't go further than the 382. All right, you can see that this red wave 2 and wave 4 meet our expectations. 618 is deep, 382 is shallow. Same for the internal wave 3 actually as well, by the way. Here, deep wave 2, right? Shallow wave 4, etc. And on that shallow wave 4, you could then add the smallest risk. So you can see how everything then ties up together with this Elliott wave and fibs. And of course the targets nicely get hit later on when we make that up move. All right, so just a way to show you if you are looking at a currency and you're expecting a turnaround here, for example, because you have divergence, you're hitting targets, whatever the reasons might be, and you see something like this, a 5 wave, and you want to attempt something like that, take it small here, and if you get a confirmation and you get some mess around here, then take it a bit bigger, etc. So you have a plan also regarding the fibs, how to scale in and scale out is another term that is used in the forex market, and how you can spread that risk management, but also your money management to get a good reward to risk ratios. Alrighty.
Okay, yeah, Chris, it's time for me now to kick off with this target price or take profit. I like to say target price, but it's basically the same as take profit. It's TP, you know. When we say TP, we refer to, okay, take profit. When the price moves in our favor, we need to learn to protect our profits. And the rules for setting up profits are always strong resistance and support lines. Those are horizontal levels of support and resistance, be it intraday or historical. Local highs and lows, or based on volatility of the instrument. This is important if you are trading with the news. If you do news trading, we need to take profit only based on volatility, because trading NFP, a lot of times I have learned that I don't need to have any fixed target price. It's very, very hard to trade NFP release, and maybe there will be a webinar where we can show how we trade it. But this is really, you know, guys, a really risky business. And statistical approach. The biggest mistake is holding profitable trade and early take profit. It's okay. You need to know it's okay if you, for example, if you bought into a resistance, then it's okay to take a profit on very next interim resistance. This is what when I make analysis on SpiderDan and on Admiral Markets blog and Facebook page, I always say breakout trade. Breakout trade is buying into resistance or selling into support. So we need to take profits a little bit of, you know, it's a risky business, but we can do that if you know how to trade breakouts. So it's okay if we go with breakout trade, it's okay to take early profit. But if we make an intraday trade or swing trade, we need always to respect our target price. It's hard, I know, because when you see that you are, I don't know, $500, $600 in profit, you always click on the button to close the position. But always try to watch that strong resistance and support levels or pivot points, whatever. Believe me, it will pay off. Those are rules for target price. My basic rule is to take profit, early profit on breakout trade, or to take a profit on next support or resistance. I personally use Fibonacci pivot points. It's also an indicator and Camarilla indicator. It really gives me a nice, and I have my manually drawn red lines which represent important price turns, and that is how I take profit. Do you have something to add, Chris?
No, I guess not at the moment. To take profits, I definitely agree. It's tricky business. It's hard to stay in there, but that's why I do accommodate that a bit with the fib targets. That, for example, if I'm aiming for a minus 618, I do accommodate, you know, certain space so that maybe 10 pips before that, depending on which time frame as well. But for example, so that if it gets close, I do get out with that take profit. I don't want to be exactly on the dot, for example. You know, but I already plan on that. So that's good, I think, to also maybe think about. We got some free slides here actually still going.
Yeah, a few slides, but just before we skip to this slide, Martingale strategy,
sure.
I will explain why we should never do this. And now the traders who are listening to us should never apply this sort of strategies. Pyramid, Martingale, that is forbidden. For my trading style, it's totally forbidden. But before that, I need to add, if you do intraday trades, try to watch ATR, average to range. It's very important for the price, at least a week. You need to find a good indicator, ATR, to set it to show you a last week ATR and to go with that. Because if you do breakout trades, you can get trapped in bull trap or bear trap. So when you do breakout trades, go with first 3 hours of London session, first 3 hours of a New York session. We will explain that on our next webinar when we will do it on breakout, how to do breakout trades. There are two or three ways of trading breakouts, but always use horizontal lines of support resistance and ATR. It's very important because you don't want to long into resistance on full ATR. Never do that. Okay, we will talk about that. Again, me and Chris use Fibs, Camarilla, and Fibonacci pivots. It's enough. Believe me, it will be enough. Okay, now Martingale strategy. What is a Martingale system or a Martingale strategy? It's a system based on popular betting. It's basically a gambler system, and it's commonly used in bets with equal or close to equal chances. You know, in some sort of casinos, red, black, odd, even, heads, tails, etc. And according to Martingale system, we should double our bets after every loss and return the bet to initial amount with every winning bet. For example, we bet $10 on our position. If we win, we get $10. If we lose, we then bet $20. And if we lose again, we bet $40. And of course, if we have an infinite amount of money, we will be always winning. But the problem is that we don't have infinite amount of money. And it's very, very hard to have a long-term success. And why those systems will eventually fail? Because in reality, we traders don't possess infinite funds. A losing streak of 10 trades will require a bet of 1,024 initial bets. It's translated to money, it's 10,240 if our initial bet was only $10. And we would need $10,000 to recover from losses. And 20 losses in a row will require 1 million initial bets. And the problem is we will eventually lose that money. And you know, that is very, we traders use brokerage. And it's not the same for gamblers and for traders, because we have a broker spread, and of course it shifts the chances against us. So we should never use that Martingale strategy. We can profit. There were times when we can profit in strong trends or something, but when there is a choppy market or very whipsaw market, it will really take a lot of money to be eventually profitable. And that is, I call that the strategy of self-destruction. And this is a good example. It's a blackjack. You know, casino will always win. No matter how good gambler you are, casino will always win. And why we are not gamblers? Because we are traders. By applying technical analysis and or indicators, we shift odds in our favor. We are stacking probabilities to our favor. We begin with 50-50% of success, but with good money management and system strategy indicators, we are adding probabilities.
Nanette, what is the difference between a Martingale? Someone's asking an anti-Martingale.
I don't know about anti-Martingale. I just know about a Martingale. Maybe you can Google it. But you know, I just wanted to know and wanted to make sure that you all know what Martingale is and why you should never do that.
Maybe it's the opposite. Guys. Maybe it's when you lose, you double down or something like that. Or
well, I don't know, guys. Be traders. Don't be gamblers.
I think the point is clear, huh?
Yeah, the point is clear. We don't need to make I don't know very big assumptions about Martingale. It's not okay for traders, for good successful traders. It's not okay.
What is pyramid strategy? Someone's asking. Pyramid strategy.
Well, it's basically adding to positions as price moves in this desired trend direction. That is pyramiding is a, how can I say, highly aggressive strategy, and it's suitable only for full-time professional traders who know how to control risk. And it should be executed only according to predetermined and tested method. It's called also scaling in. For example, if you have a strong trend and we know where our target price is, definitely we are scaling in. We are adding to our winning positions. And it increases profits, if, for example, if the trend continues as we hope. But it can really be dangerous if only the trend reverses, because it will increase losses.
Yeah, I only do it if I have the first trade out of risk.
Yeah, Chris, but you're a full-time trader. Don't forget that.
Also, yeah, but then even I only wanted to do it when the risk of the first one is off the table. Indeed, true.
Yeah, it can be, yeah, but this is the most important part. Don't do it if you're novice traders, because adding to positions changes the total cost of the entire position on a per unit basis toward the last price. And that can lead to quick reversal of the original entry price, and that results in a significant loss. It will really increase your losses. And you know, Chris probably knows how to do it because he has a signal to add to positions when, I don't know, some price points trigger. For example, I don't know, volatility bands, moving averages, FIBs, and so on. But I do reverse strategy. I do add to retracements. Someone may call it adding to losers. It's not adding to losers. For example, if I entered at a 31.2 fib and the price went to 61 fib, I would add because I know where my stop is. And if I follow the trend, it is a very good strategy. And Chris also explained you that the move can lead to 78.6 or 88.6 fib retracement. But if we control our risk, if we don't do it, you know, I cannot enter with a full lot on 31.2 fib. I will enter maybe on 3% of risk. And I will add as price goes in contra of my first position. So I will add to retracement. And this way we ensure more profits. Do you agree with me, Chris?
Oh, absolutely. Definitely. And very, very good method of maximizing and optimizing our tool.
We will show that on practical examples. We will do that. But adding to retracements can be really profitable as long as you respect money management. If
you have to plan for it. You have to. You can't say, oh, indeed, 30 pips is down. Let me do it. You know, now you have to think about it before you actually trade the plan and plan the trade. Exactly.
Yeah, you need to calculate your risk.
Yeah.
Always calculate your risk.
Yeah.
And your risk is based on your stop loss. You know that. And now the rules, 12 rules I made for successful trading.
Yeah. I'm just, to be honest, I'm running a bit out of time myself. But maybe we can just mention them now quickly.
Yeah, we will mention it.
We will then close down the room here. We got some nice overtime already.
Yeah, Chris,
for our viewers, that's a great thing. So yeah, getting to know your pair, of course, is very important. Absolutely.
Yeah,
characteristics,
get to know your pair.
Yeah.
And then get ready to trade. Study the charts. Stick to your plan. Don't trade blindly. Don't be greedy. Accept the loss if it happens. Just don't chase the markets. We never buy into resistance or sell into support except for breakouts. We don't overtrade because it will lead to revenge trading. Many successful traders trade only a couple of hours per day. Follow the trend. Avoid choppy market. Take better care of protecting your profits than making big profits. This is very important. Take care of the impending news and cut your losses short, let the profits run. This is summary of all we did today.
Yes, nice summary indeed.
This is the summary. Yeah.
Yeah, absolutely. The roadmap for trading and your trading plan for successful trading. And here's some do nots actually, which make a lot of sense to me. Not using loans, for example, and being careful also with how much of your savings you invest makes a lot of sense. Yeah, and you also mentioned something, leaving a stationary workplace. You mean, what do you mean with that?
Yeah, guys, if you have your day job, you should never quit your day job to choose to trade to be trading to be your main occupation. Because if you quit your day job, you are not sure of your trading. Don't do it because you won't earn consistent profits. Only leave a stationary workplace. It's leaving. Basically, it's leaving your day job if you're sure that you know how to trade, and if you have money for trading. You cannot start a business with $1,000. It's really hard.
Yeah.
Not to say $100.
Yeah. Attract unfamiliar traders for your asset management. Yeah, that's a bit dangerous.
Yeah, a bit dangerous. If you give your account to an unfamiliar trader, you can lose it all. If you don't want to trade, if you want to invest, try to find a good trader. We have currency. Maybe you have a friend who knows how to trade. Well, you need to take care of your profits. And you should never buy an expert advisor, a mechanical trading system which promise substantial returns. Internet is full of that. Internet is full of scammers, marketeers that sell systems for $97. This is all fakes, guys. There are a couple of traders who are really who have been proven to be good in trading, but most of those systems, $97, are fakes. So don't use it. That is, if you ask me, I would never buy a system, and I never did it for $97, really.
Absolutely. So make sure to follow Admirals with Twitter, Facebook, and try our investment game. Tell me more, Anenet, about this.
Well, yeah, there are a lot of investment again on Facebook, but to be honest, Chris, I don't have just time for games. I'm really doing, this is full-time job. I'm doing analysis. I'm doing trades. I'm trading 2 or 3 accounts. I'm really getting my head is full of numbers, and I would like if I had time really for these guys.
Me too.
But guys, check it.
Cool. All right.
You can always check. You can always apply for Forex Ball. I encourage you to do that.
Exactly. So that's about it, folks. I had a great time. We have one more question actually from Mohammed that's asking what's their email, and do you do a trading room too?
Trading room. Well, Chris, maybe we should think of that, but not at the moment, I think. Maybe we will have our training room one day, but guys, this I cannot tell you how this is really a hard job to trade every day, make analysis, and well, it pays off, but it's not easy. Just we need to let things settle a bit. Maybe we will think about it. Why not?
Yes. Exactly. Cool. I'm looking forward to next week's webinar already, Vicky too, so that's good to hear. Not sure what the topic actually will be next week.
Thing.
Yeah,
sorry, Chris, one thing before I forget what I wanted to say. Guys, why I picked up Admiral Markets? I have money. I could have picked up, I don't know, maybe Alpari or, I don't know, FXCM or other brokerage. But the main thing is Admiral Markets, my view and opinion is it's really an honest broker, and what is the main advantage of it? Really has tight spreads. I will never trade a broker with 3 or 5 or 4 points spread on majors. This is not my way of trading. I don't like to do that, and one of the main things is Admiral Markets has a really a good way to caretake about their traders. Spreads are really awesome. We can have this kind of ECN spreads even on 1K account, and it's really a good thing. So guys, that is and execution is fast. Everything is very smooth. Withdrawal of money, it's really it's excellent. So that is why I picked up Admiral Markets for my personal trading brokerage.
Cool. So folks, you know what the next step is. Hit the website page of Admiral Markets and take a look at all the advantages. And actually, I looked at the topic of next week. That's going to be NFP strategies. So April the 18th, same time. And the week after, we're going to be talking about how to trade divergences. So looking forward to that. Thanks. Yeah. Thank you all for being here and staying along for us for this nice webinar. And hope to see you next week.
Yeah, thanks for comments, guys, and see you soon. Cheers and many green pips to you.
Cheers, guys.
Cheers.
The organizer